What about all of these lenders that reach out to me saying, but hey, no experience, zero money down? Why are they doing that?
We call it the old, bait and switch.
Right.
So they do it to continue the conversation, get you involved, put some money up front to get you in. And then once they start going to underwriting, you will get back from them. Well, we cannot do 0% down, but we can do 15% down. I'd be very weary when people call and tell you that you're not going to have to put any money down.
Welcome back to this week's episode of the Lady Landlord Podcast. I am your host, the founder of Lady Landlords, Becky Nova. And today we are actually going to be following up with a part 2 series all about hard money lending. So I have Rick Haberman here from Rocky's Funding. Rick, thank you so much for joining me. How you doing today?
Good. Thanks for having me.
Yeah, of course. So we had Michael Haberman on a little while ago and really just went over what basics within hard money lending was. So I'm so happy to have you on to kind of break this down and really make sure that our lady landlords are so prepared to be able to work with hard money lenders now in 2024. So if we could just start, I would love by you just kind of sharing a little bit about you and just kind of introducing yourself to our audience, please.
Oh, sure. My pleasure. So I am the middle brother of three brothers who are all in this family business that was originally started by my father and his old partner. My older brother, Howard, joined the business first, and then I came in 2001. And then, as you mentioned, my younger brother, Michael, came in about 7 years ago. So my prior life to the hard money business, and I still do it today, is I am commercial airline pilot for a major airline. So I split time between doing that and doing the family business, the hard money lending business. So when I'm not flying around the world, I am working on the family business, whether I'm home or overseas somewhere.
That's very cool. I do not get to talk to pilots on a very regular basis here. If you had to only do one, which would you do?
That question has been posed to me in the past, and my brothers have asked me that, and I don't think they like my answer sometimes, but I love doing the family business. I like being involved, but my passion is flying. So if it came down to it, I would pick the flying. It's never had to come down to that, thank God. And it was because of the airlines is that I wound up in the hard money business basically after 9/11 when,
Oh, wow.
you know, I lost my job. So that's what brought me into the hard money lending business. I was living in Guam with my wife, flying out there. And then 9/11 came. And by October, I was back in New York. And that's what my older brother Howard and my father were doing it. And that's what brought me into the business. So 3 years later, here I am
Wow.
still doing it. Yes.
Very
So,
interesting. That's interesting that you have kind of those two different career paths, two different really sides of that personality. What I think is great, and one of the things that we talk a lot about in Lady Landlords is how really investing in real estate allows us to kind of have options in life, that it just doesn't have to be great. I'm going to go sit at this desk and work there until I'm 65, or these days, retirement's probably closer to 70. But really, you can kind of have that little bit of a life by design. So the idea of either you living in Guam, between now you being able to split your time between being a pilot and also doing hard money, that it sounds like you were maybe like the little bit of the OG lady landlord here, really by creating that schedule and really
yeah.
being able to make sure to do all the things that you really wanted to do in one.
Yep, yep. Me losing my job and getting into this, it's been a blessing. So it's gives me a little backstop instead if something were to happen with the airline, another downturn, stuff like that. So it's really been beneficial
Right.
to have
Kind of
this.
like that pandemic that happened in 2020 when a lot of people weren't flying so much, kind of something like
Like
that
that,
happening again.
2008, 2009. So,
Mhm.
one of the, I guess, advantages of me getting older is I become more senior. So those things that when they happen, they tend to happen to the more junior and shall we say younger guys than myself. So sometimes it's good to be a little bit older,
Well, senior, right? That's the seniority
senior,
speaking that allows you to
wiser,
do that.
wiser.
Wiser. Senior,
Yes.
exactly, exactly.
It,
So for those that haven't listened to the part 1 episode about hard money lending, and for any of our listeners out there, if you have not heard that episode, I highly recommend you actually pause this one, go back, listen to part 1 of hard money lending. But for those that are gonna continue and move forward with this episode, Rick, can you just define what hard money even is?
so hard money is a term that was brought out years and years ago. I think when it first came out, people didn't think of it as something really kind of like you're in desperate need of money and that no one else would lend you money. Maybe your credit was poor, no experience. So it was kind of high interest rates, short-term loans, that you better pay back the money. I think it kind of had a bad connotation to it, but we always looked at it as we try to say we were more of a private lender. It was just a quicker way to access money than going to the banks. Yes, paying a higher rate, but it wasn't for people who could not get loans because of credit issues. It was really just a way for investors to cut out all the paperwork that you might run into with a bank and be able to get your money quickly, to be able to close quickly, to get your project going.
Right, because to me, it's kind of become another loan product rather than it's not a payday loan, right? Kind of what you're saying with all of a sudden,
Correct.
these ridiculous interest rates and they'll just give them out to anybody that has a pulse, just like they were doing back, 2008 and before. But really saying like, hey, based on what your needs are, this is a viable option depending on how your investment portfolio is shaking out. So where does the money from hard money come from?
There's many different ways that it's coming. The industry has changed, especially after 2008, 2009. When I started, there was very few hard money lenders. It was our company, and there was someone who used to work for us who split off and started their own. That was really the only hard money. The money came from banks, maybe wealthy individuals that someone knew, maybe some family members. Now it comes from banks, hedge funds, private equity, again, family businesses. So there's a whole array of now private lenders that are out there.
Right. Because really your father who started Rockies is really kind of known a little bit as the godfather of hard money, right?
Yeah, he started back in the mid 90s, again when nobody knew about it and there weren't any lenders out there. Him and his partner started the lending business, correct?
Right. And what I think is so cool about it is it's also the way that you described it there. It's a bunch of investors that kind of pool their money to then lend to investors. Right. So what I really
Yes,
think is actually great about that is everybody kind of a part of that chain understands investments, understands the power of really what you can do with those things. So I think it's really kind of cool that maybe I'm using hard money lending now to grow my portfolio. But in the future, I would then love to be the person that's actually funding the hard money deals down the line.
that's true. I've seen it. I've seen it over the years. I've seen some clients who started off as fix and flips and then started their own lending business. Said, I want to be on this side of the table instead of the fix and flip side. So I've seen it happen. So it is possible.
Well, anytime you can start to cut out contractors and then maybe even tenants, usually that's something that as we become more senior and wiser,
Yes. Yes.
right? Then all of a sudden we
It
want to start moving away from those types of things, then having to do the day-to-day operations, either being
correct.
a project manager for a fix and flip on some contract, or then once again dealing with just tenant calls and tenant situations all day. So I feel like
Absolutely.
that is the seniority that we look for
Yeah,
as real estate
exactly.
investors.
There you
So
go.
so within Rocky's funding, within the hard money lending business that your family runs, which I think is so cool that everybody is a part of it. What is your specific role in the business?
So my specific role is to be the head of underwriting. So I look at any deal that is going to be funded, as shall we say, in-house using our own funds. The loans are brought before me to determine if it's yes, we like the loan as it's structured, whether we like the loan, but we need a little bit more information, or we like the loan, but we want to maybe reduce the loan or have them come up with a little bit more money up front, move it around, or if we do not want to do the loan. So we have, besides my brothers and myself bringing in loans, we have other loan originators that
Mhm.
bring us deals. So those deals are brought forth to me, and with not a partner, but a gentleman I work with, we look over the loans and we give our final blessing on a yes or no. Or we do have access to move it to some other source if we decide it's not for us, but it could be something that we think should be funded, just not through our personal access of money.
Gotcha. So whenever I hear the word underwriter, I think of the person, and I'm sure everybody else that's ever bought a home does. We think of the person that keeps saying, "Hey, I need your bank statements. Hey, now I need now I need this documentation. No, I need now that letter of employment. No, okay, well, it's now been another month, so now I'm gonna need that paycheck again." Right?
Right, right, right,
So
right, right.
so with hard money lending, just as much as traditional loans, there's always an underwriter that's involved, correct?
Correct. Correct.
What are the top 3 things that you look for as an underwriter within hard money to say, "Hey, this is somebody that we're gonna be able to give a loan to, or this is somebody we're not."
The first thing I look for is their experience level. I'm looking for that experience as far as that they have been a member of the LLC or corporation, or I can verify that it was them buying the property and them selling the properties. That's what I mean by their experience. There's different experience levels where, say, someone might be a GC, but has never purchased in their name before, but we know can do the work. There's maybe a realtor who always gets properties and maybe was a silent partner with somebody, but they weren't on the paperwork. So, first thing I'm looking for is what's your experience level where I can verify that you were the actual buyer, you were actual seller. That would be my first. Second, I am looking at your credit. And then third, I am looking at the property itself.
Gotcha. I wanna stick with experience for a second here. The influencer world has kind of taken over. So I feel like a lot of times on Instagram or YouTube videos, you see people being like, "Oh, no credit, no money? Cool, just go use hard money. No
Right,
experience needed," right? And that's
right.
really not the case at all. So I
Correct.
want to dig into a little bit, and it sounds like there's a little bit of leeway for what necessarily experience means. But let's say I'm going and I want to buy my first rental property, and it's going to be
Okay.
something that I'm going to fix and flip. If I own my primary house, is that enough to count really as experience? What if maybe I did some rehab on my own property? Do those types of things count? Or because it kind of becomes that chicken or the egg scenario where I need to have
Right.
done the flip to have gotten the loan for hard money, but I need the hard money to do the flip. So there has to still be some type of structure. Do you kind of encourage people to have that conversation and talk about what they've done? Or is there something that you're, like, literally looking for keywords?
I do not count a personal residence as experience. I will count experience if you're a real estate agent or you are a contractor or an appraiser. I would give weight to that. I would give weight to experience if you were involved with somebody on a project, even though you weren't written on the project. If you tell me that you were involved, but it's just not my name, I'll give some credence to that. It'll just adjust how much I might give you as far as an advance rate. It will be lower than somebody who I can verify has done one, two, three, four fix and flips or fix and holds than somebody. I'm going to give them a more of a larger advance rate on that. So I do take those into consideration when I'm looking at it. And then back that up if you have strong credit, you have financial backing, the resources to get us to that comfort level that you're able to come to your closing and come with the amount needed and your closing costs and the money to carry the loan. I will look at all that and then finally look at the deal itself.
Gotcha. So it sounds like there is a little bit of space for what really experience do you come with, more experience, maybe a little bit more favorable terms than somebody still needing experience, but just less experience, or once again, maybe in a slightly by proxy way. Once again, a realtor versus, a contractor. To me, those would kind of be a little bit different of a role. So you can at least kind of
Right.
give them almost a scoring system here with being like, cool,
Correct.
you're a contractor, you've done 19 flips with Rocky's funding specifically, you get an A+ versus,
Right.
okay, you're a realtor, you're not a contractor, haven't bought a specific property. Hey, we can give you a C. Right.
Right. We can
So
give you a seat, but it's going to be, like I said, this is much of an advance or this rate compared to someone, who has that more experience. We're going to give you maybe a larger advance up front rate. So we have, different matrices based on your experience level where we like to, what we feel is what's out there in the market for, what you're asking as far as advanced experience, credit scores to determine where it should be.
okay. You use the word advanced often, right, when talking about the loan. In that, are you
Okay.
talking about the funds after the down payment specifically? Or are you then also using the word advanced to also include what would be given towards rehab costs?
When I'm saying advance, I'm referring to how much money we will give you at closing for the purchase.
Right. So, in
That's my
that
advance.
sense, hey, you're a contractor, you've done 19 flips for us, maybe 25% down because you got that A+. Hey, you're a realtor. This is going to be your first personal investment opportunity. Maybe a little bit more toward the 35% down is what you're going to request, which would then mean less for you to be funding that loan, correct?
Correct. It'll be it's less for me to be in on the front end, but I will always offer the renovation money, back it up with 100% renovation. As a lender, I want to make sure that there's money there to complete the project. So I've got two there. There's
Right.
money there, and we want to be able to see that the project is progressing. So as the borrower needs money, they need a draw. So in order for the draw, someone has to go out and inspect it. That way, we now know you're moving along on the investment. Because if I just give you money up front and I never hear from you because you're funding it yourself, I don't know if the project's moving along. You could still be paying me every month, but you
Mhm.
haven't done anything for the project towards the renovation.
Right.
And then when it comes time for the loan to be due, we still have an unfinished house left. So we don't like to get into that situation. I like to know that the money is there for the borrower to renovate.
Right. That makes perfect sense to me to then have somebody have that skin in the game. And then once again, a
Right.
little bit less experience, a little bit more skin in the game that you need to put in there, but clearly not to penalize somebody from actually getting the rehab done, which is one of the two words of fix and flip, right? Like you clearly
Right.
don't want to penalize them and say, okay, well, hey, we know maybe you have a little less experience, so we're going to really put you in a poor position to even get this rehab done. That's not going to be
Correct.
good for your loan in general. So
No.
clear to make sure that that part's fully funded. But then once again, less money necessarily for the closing up front, really
Right.
ensuring that that other person is a little bit more solid to be able to get that deal done.
Right. The theory is the more money someone has in upfront, the more likely they are going to do what they need to do to complete the project to get the return on their initial investment and then make their money. So that's the theory.
Right.
Does it always work out that way? No. But that's the theory. That's how we assess the risk. You have more money in upfront, you're less likely to pick up and walk away from that money.
Of course. Of course. In general, for hard money lending, what would the range of a down payment be that somebody should expect? And once again, we're not going to hold you to these numbers here, but just something from the experienced investor that you've worked with multiple times, that has a contracting license, that you've known for years, that's always paid you back, to somebody that, once again, is on the newer side, that realtor coming to you saying, hey, I'm ready to make that switch to investor. What would people even need to be thinking about when coming for hard money?
Anywhere from 10% down to 30% down. is what I think you can expect a private hard money lender to offer based on your experience level, 10 to
That's
30%.
okay. What about all of these lenders that reach out to me saying, but hey, no experience, zero money down? Why are they doing that?
They're doing that just to get you in, to continue the conversation. That's what it is, to start submitting your paperwork to them, to get you to go out and do the appraisal where you're most likely paying for the appraisal. Okay, now you've got money in, probably charge you an application fee, $1,000. Okay, now you're in. And then what I've seen in the past is once it goes to that underwriting process, oh, we can't offer you 0% down based on whatever excuse. Oh, the house didn't come in the way we thought it was going to come to. It needs more work than you said it was going to need. We call it the old, bait and switch.
Right.
So they do it to continue the conversation, get you involved, put some money up front to get you in. And then once they start going to underwriting, you will get back from them. Well, we cannot do 0% down, but we can do 15% down. At that point, maybe you bought the property from an auction and maybe you had 2 weeks to close. Well, now you're under the gun, right? You need to close. What am I going to do? I have to close or I lose my down payment, or maybe you got the property from a realtor and it's your first time working with the realtor, and now you're going to tell the realtor you can't close. You're probably not going to ever hear from that realtor again. So you've just burned that source of properties for you because that realtor is obviously making commission on their sale and they're hoping to get the property when you go to sell it so they can make it on both ends. And now you tell them, I can't close, you burn that bridge too. So it's kind of a tactic. Now you're under the gun. I gotta close. What am I gonna do? I don't have time to find a new lender, getting a new appraisals, because I would say most lenders are not going to accept another lender's appraisal. So I gotta go through the process again. I don't have time. So I'd be very weary when people call and tell you that you're not gonna have to put any money down.
Right. Absolutely. Yeah. Zero money down, zero experience. So would absolutely be red flags going off in every lady landlord's head saying that this is not adding up and not making
Right.
sense. So that's why it was really helpful to kind of say, hey, somebody that does have quite a bit of experience, really the best even that they would expect would be even that 10% down. Best case
Correct.
scenario was very, very helpful. And that really for somebody on the newer side, a little bit closer to that 30, maybe even a little higher, depending on what that situation is. Those types of things
Correct.
are very, very helpful to start thinking about what is realistic and separating the people that are out there that have legitimate businesses versus the other people that honestly, there's some companies out there that are perfectly happy to accept your application fee. And then they say, hey, no, actually, we need 50% down. Oh, wow, that's too rich for my blood. Great. But they already have your $1,000 application fee. Right. And they just
That's
sell a loan, they sell application fees. So
correct.
so the second thing that you said in there outside of experience was that then you mentioned a strong credit score. What does strong credit mean to you?
Strong to me, 700 and above is a strong credit score for me. So when you're talking about score, you can have a strong port, but
Mhm.
your score doesn't necessarily reflect that because of the way the credit agencies rate you, how much outstanding balance you have compared to maybe how much income you're reporting, how many open lines you have. So you could have 3 pages of perfect pay,
Mhm.
but your credit score could still be 660, 670 because of the amount of outstanding debt you have. So when we look at it, we underwriter, we look at the score, but we also dive into a little bit of the report to see, you know, why it's a 700 or why it's 660. Because like I said earlier, I have seen reports where it's a perfect pay history. You just have a lot of outstanding debt, which can raise a concern as well. If you have this
Right.
much debt and now you're taking on more debt, how much liquidity do you have? You seem to be making your payments, but
Mhm.
where's that source of money coming from? And we don't typically look at bank statements. That's why I said earlier, the experience is the number one thing I I look at first before I even dive into the credit. But I would say you have a 700 score. I consider that a strong credit, 700
Gotcha.
above.
And that's also and as you were speaking about that, the first thing that popped into my mind is actually I had just closed in a three family about a month or so ago. And I got the credit alert just the other day saying, hey, now the loan is posted. It impacted my credit score. Fine.
Right.
So when I looked at it, make sure there was nothing else that popped up that was incorrect, that it was the loan that I expected it was. And I always get a piece of advice from the credit report company about how I can improve my score. Now, meanwhile, my score is already
Right.
above an 800. But the
Yeah.
one piece of advice that they always give me is that I should have credit for a longer period of time. Well, how
Yeah.
am I supposed to change that? Right?
Right.
Like I'll get there, but to me, it gives me a option of a thumbs up or a thumbs down on if I thought that that was useful information. And I'm always like, no, not not
Yeah.
really. I can't go
Yeah.
back and start my credit any sooner. So I do love what you're saying here about not only is that number important, but then also it takes a couple minutes to still be able to review kind of where that score came from and what else is going on. Now,
Right.
with hard money though, using an LLC is
Yes.
important for the closing, correct?
Yes, we require that all loans are closed in LLC, and the members of the LLC personally guarantee the note. So all loans are closed. We don't close any loan in personal names.
So you would look at all the members' credit scores, correct?
Correct.
That will be parts of the LLC. And then do you ever have people that come to you saying, well, here's my LLC, look at my business credit score instead of their personal? Or is that something that you don't allow?
We don't allow. Everything is only personal credit scores because again, they're guaranteeing it. And we have some customers, every time they buy a house, they have a new LLC. So there really is nothing in the LLC except for the house. That's it. And then that company gets shut down. So everything is based off of the personal credit. And it just circles back to first thing I look at before I even get to the credit, what's the experience? What's the experience of the people I'm lending to first?
Right. That's really important because I see this all the time, like on YouTube channels. I would just like open your LLC, get a bunch of business credit, go get a hard money loan. And it's like, no, it's really you. It's you personally. So it's okay to open the LLC right before the closing because it's just to close with the property in the LLC. And why is
Correct.
that? Why is it important to close the property in the LLC, yet have the personal guarantee by the members?
Well, most people like to close in their LLCs for their tax purposes, which, is not something that I really get into it. We had to do it as LLCs is because of usury laws in the States. You can only charge individuals so much interest, whereas an LLC, you weren't restricted by it. So that's why we were required on the LLCs. And then the personal guarantee is just, it's like the skin in the game. You have more money up front, you're less likely. If I have a personal guarantee, from you, now you're on the hook for that money as well. So if it got to the situation where we had to go back and get the property, you can go back after the members for the money that's owed on the loan.
Correct, because that's the whole name of the game here. I'm lending you money to go finish a project and be able to make some money. I want to ensure and do the best that I can to make sure that you're going to be able to pay that loan back, right?
Sure. All about mitigating our risk. You can obviously eliminate the risk, but you try to reduce it as much as you can.
Right. And then the third thing that you said was then evaluating the property itself. Where does that come into play here?
Well, when I say the value, look for certain things. Is this house unlike any other house in the neighborhood? It tends to be the red herring. Is it sitting right next to, on either side of it are empty lots? Where is it located? Location in real estate. So we look at the property first. And when I say that also, I mean like the deal itself.
Right.
What's the purchase price? What's the renovation? We look for, is it in a rural area or urban area? How far the comps are going to be. And a lot of that will be done through the appraisal, but we will take a look at the house first and see is there's one house here, but there's not another house for 5 miles around. Is that something that we really want to go into? And again, that can go off to if the borrowers come to me and this is the type of area that he works in and these are the types of properties that he does, well, I'm going to give the credence to okay, he knows this neighborhood. Whereas if you're
Correct.
brand new to it, might be not maybe the one that I want to do.
Right. So that's really interesting how all those pieces are kind of coming together there. That once again, maybe that rural property out, in that long stretch of, cornfields isn't exactly, the moneymaker
Right.
here. But if you find a person that really has been able to have a successful track record with those types of
Correct.
properties and can explain
Correct.
almost their business model to you and be like,
Right.
hey, here's exactly how this works with the deal I have with the farmer, whatever it may be. And
Right.
this is what I've been doing for 20 years.
Yeah.
Well, okay, that sounds like a good candidate compared to somebody that's brand new, but yet in a city, right? So it's
Absolutely.
really kind of taking those different pieces kind of into place. I also like that because I feel like then you're almost checking numbers from a deal analysis that an investor should have and hopefully already did. But then really it sounds like a kind of confirmation. If somebody says, hey, I think this is a good deal, I think I can make some money on this flip. It also sounds like you're going through kind of almost doing that same analysis to see if this flip really is going to produce and yield an income in the end of it or not.
Absolutely. And one of the things that, we pride ourselves on is we want the investor to make money. We do the lending, we stay on our side of the desk, the investor goes into. So we will look at a deal.
Mhm.
And even with investors that have been with us for a long time, we've had those conversations of, why are you doing this deal? I don't see where you're making any money. It doesn't help the investor or the lender if the investor doesn't make money, because they'll get to a point where they keep seeing they just putting in money, 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 and see they're not going to make money, that they could just walk away and say, why am I going to throw good money after bad? So we like to analyze the deal before we even move forward. As we talked about earlier, you go pay an application fee and you go pay an appraisal fee and stuff like that. We're not interested in a borrower going to spend money without seeing that it's first, a viable deal. So we do look at that. We do look at that first, because maybe you think it's a good deal. We put our input. Maybe we had a loan on the house down the street from it, all different factors. So we will talk to our investors and sometimes look at it and go, what are you seeing that I'm not seeing on this? And
Right.
have you thought of this cost that's involved with it, and take that from your profit too? So we do like to look at deals before we start moving in and moving forward. So that way, when the deal, we look at it and we feel it's good. And when they do the appraisal, it's typically coming back right where we thought it would be and right where the investor thought it would be. There are times where the appraisal has not come in close to where the investor thought it might. So then you have to have another conversation. But we try to take care of that off the top. So that way, when we do get the appraisal back,
Right.
we've already looked at it and we can just expedite it through the underwriting process.
Right. And you already feel good about it at that time. What I love about that is it really shows that partnership between
Right.
you as the lender and the lendee here. So I love that really it's let's take a look at this together. Let's make sure it's going to make sense for us, make sense for you. And that really, once again, everybody's able to make money in this space. So I think that's
Right.
really cool. What are some things that excite you when somebody puts in an application with you? Like, what are certain things that you're like, yes, I'm seeing that they do this, that they do this. This I know is going to be a good candidate for a loan from us. What are the things that you're like really happy and excited to see?
I like to see when people that used to work for one of our investors and now has kind of split off and started their own. So now it's a whole new generation of people investing. I like to see someone who did the loan on their own and now is ready to go with the hard money, and that we're able to start growing that business, start growing that business, and then just watching the whole process play out. I really like watching when someone takes and you see the house and it's a complete mess, and then we're funding the renovation and we're doing the draws, just to really see that house come along to the finished product and to know that we're a big part of them being able to do it and someone's going to have a new home out of it.
Right. I love that. I have to ask on the opposite side here. What are a couple things that when you see an application come through that you're just like face palming that, being like, this is not going to be a good candidate for a loan here?
I don't like to see people who try to step out of their box real quickly. And by that, I mean, I bought a house for 100,000 and I did 50,000 in renovation and I sold it. I made some money. And now I'm coming to you and I'm buying a $600,000 house and I'm putting $300,000 in renovation. And they're telling me it'll sell for 1.4. That does not get me excited because that is a huge jump from what you were doing and what you did on your first to go to your second house. Now I'm not saying that that person now has to stay in 100,000, do 50, but maybe the next house is 150, 175, 200, a little bit of a higher renovation. Okay, that's fine. It's in the same area that they're at. So I like for them to be staying in their same gradual working up and staying in their same area because different markets are different markets. You know, I've had borrowers who were very successful in New York and then they go to Jersey and get killed because it's different neighborhoods. You
Yeah.
know, you could go in some parts of a state or some parts of a city, and if you don't know the block by block, it could be a huge difference. So
It's not just the market, it, like, specifically from block to block, that is huge, a huge component of it. But also when I hear a difference between New York, New Jersey, I'm hearing a different crew, different
yeah,
team, right? Like, that's one of the
absolutely.
things that, like, I really love about the portfolio that I build is I buy in 2 very specific areas. And then that
Right,
way, great, it's this lender, this attorney, that contractor. It's the same people, the same
right,
team. I know how you like to work. I know you always kinda take off a little early on Friday afternoons. I
right.
know, though, that I can always count on you to show up at 8:59 Monday morning, right? You kinda get into a little bit of a rhythm with
Abs
somebody.
absolutely. And you start to set the market too, right? You're in that
Yeah.
market, and if you're flipping, you know, and you're buying something else, your houses are becoming the comps for the appraiser. So you really get to know that market. So I don't get excited. And that's before I even start looking at their credit and stuff. Obviously, if you have poor credit, that doesn't get me excited. But again, as I mentioned earlier, that experience level and past history of what you've done is really the things that we look at first. That's really the thing I look at first. So yeah, going from getting out of your box a little too fast does not I don't necessarily wanna take that ride with you on that first one where you're going from, 100,000 purchase to a 600,000. I wish you luck, but it's not really the ride I wanna take with you.
Well, once again, your role is really that mitigating risk and really making sure that people are setting themselves up the best they can for success. And sometimes, once again, that kind of just, a little pie in the sky might be a little bit too much in some spaces
Yeah,
and a lot of
yeah.
a lot of different factors. So that's really, really helpful. Last question I think I have for you today is, what is one thing that you just really wish real estate investors knew about hard money lending?
As far as what I could say, it's something that you can use to really build your portfolio and develop a relationship with. It is quick money. You do have to watch out for some of the zero money down. You know, just do your due diligence when you're looking for a hard money. If it seems too good to be true, it probably is too good to be true. So that's a good question.
Thank you. Well, I feel like that's that idea and what you're saying with doing your due diligence. And if it's too good to be true, that it probably is, it really goes into that category of us as real estate investors being CEOs of our own portfolio. And therefore,
Yeah.
when we make those decisions, we also don't just have to go and say, oh, this person will give me a loan. Okay, great. Now you're in the driver's seat. But also, we have to take the responsibility of saying, like, hey, have these guys done loans before? How long
Right.
have they been in the business? Are they doing loans in this area? Do they
Correct.
know what this market is? Do they know really how they should be funding these types of things? And that's really on us as business owners, just as much as it is on Rockies to really say, like, hey, this is the right deal for us. This is the right type
Right.
of loan. So I think that's a really valid point to bring up to say everybody in this part needs to understand what their role is, that they need to really get very clear on why they're using this type of lending, what their exit strategy is. Is it the best type of lending? Are they qualified for that type of lending? Even before they come into it, just as much as they need to vet the lender, who then is just going to come right back and then vet us as investors as well.
Correct. I agree. I agree.
Well, thank you very much for joining us for our part two of our hard money lending episode here. That was so great to really break down the underwriting part of hard money lending. So, Rick, thanks so much for your time today. I
Thank
appreciate it.
you. Thank you
Yeah.
very much.
For all of our listeners out there, do make sure to hit that subscribe button so you do not miss the next episode of the Lady Landlords podcast. We release new episodes every single Tuesday. And if you enjoyed today's episode, do make sure to leave us a 5-star review. This always helps other lady landlords find our podcast and get the support that they need. Lastly, if you would like to reach out to Rick and learn more about how a hard money lender can help you on your next deal, make sure to go to lady-landlords.com to be able to get his contact information and set up a time to chat. Thank you so much, and see you next week for the Lady Landlords podcast. Thank you for listening to the Lady Landlords podcast. If you're feeling stuck in your real estate investing journey, visit lady-landlords.com to book a 15-minute orientation call with me and see if you're ready to join our mentorship program. Or you can subscribe to our newsletter and join our Facebook group for exclusive real estate investing tips and offers. Invest with confidence. Become a lady landlord today.